What if I told you the invisible engine powering the food in your pantry, the fuel in your car, and like even the treats you give your dog just have one of the most wildly contradictory financial quarters in its history?
And honestly, pretty much nobody
Right.
noticed.
Nobody noticed. Welcome to the deep dive. Today, we are cracking open the massive, highly complex world of Archer Daniels Midland, or ADM. We're using their first quarter 2026 earnings presentation, which dropped on May 5th. And just as a quick side note for you, the listener, we literally had to bypass a Cloudflare security check on MarketBeat just to prove we weren't malicious bots trying to scrape this data.
Yeah, they guard this stuff closely.
They really do. So our mission today is to decode how this heritage global conglomerate manages, incredibly volatile commodity markets, shifts toward futuristic food tech, and navigates the heavy hand of government regulations.
It really is a masterclass in corporate navigation because, if you just glance at the top line numbers for Q1 2026, ADM appears to have had a thoroughly boring, completely stable quarter.
Just totally flat, right?
Yeah, exactly. Their adjusted earnings per share hit $0.71, which is a modest 2% increase from last year. And their total segment operating profit sat at $764 million. That's up just 1%.
Wow, 1%.
Yeah, so if you're a casual observer, you'd look at that 1 to 2% growth and just assume it was a giant ship sailing on a completely calm sea.
But reading through the source material, that calm, top-level stability feels kind of like a mathematical illusion.
Oh, absolutely.
It completely masks this massive amount of volatility bubbling right beneath the surface across their three main business segments. Like when you actually disaggregate that $764 million, the narrative just flips.
Completely flips. You see some divisions absolutely soaring, while others appear to be taking catastrophic hits.
Okay, so let's get into that. Because to really understand ADM's overall stability, we first have to look at the segment that took the biggest apparent hit on the balance sheet, right?
Yeah, ag services and oilseeds.
Right, where their operating profit plummeted by 34%, dropping to $273 million.
Okay, let's unpack this. Because looking at the raw physical data, that 34% drop makes literally 0 sense.
It really doesn't, on paper.
Because ADM actually broke crushing production records this quarter. Plant process volumes were up, oilseeds tonnage produced increased by 2%, and within that very same segment, the ag services side saw a 26% profit increase.
Driven mostly by strong North American exports. Yeah.
Right, specifically a really robust corn export program and increased trade with China. So they are crushing more physical product than ever. They're exporting more than ever, and yet the segment profit drops by a third. How does making more physical product equal less profit?
It sounds like a total contradiction, I know. But it makes sense when you dig into the mechanics of commodity accounting. The culprit here is what they categorize as mark-to-market and timing impacts. Sure. The sources detail that a $275 million net negative impact hit their books this quarter. Roughly 70% of that hit the crushing division, and another 20% hit refined products and the RPO division. So wait, let me make sure I'm getting this. They didn't actually lose $275 million in cash out of the company bank account, right?
No, they didn't.
Is this like owning a rental property where the Zillow estimate suddenly drops, making your net worth look terrible on paper, even though your actual monthly rental income from your tenants is steadily going up?
If we connect this to the bigger picture, that analogy is pointing in the exact right direction. It's a paper valuation issue tied to how they manage risk. Mark-to-market accounting requires companies to value their current inventory and their forward contracts based on the market prices on the exact day the quarter ends.
Right, taking a snapshot.
Exactly. Now, here is the incredible paradox of this specific quarter. This massive negative paper valuation was actually triggered by a wildly positive real-world event.
A positive event caused a loss. Walk me through the mechanics of that.
Oh, well, it comes down to how a massive commodity player hedges their bets. ADM holds mountains of physical inventory, soybeans, canola, you name it.
Mountains of it.
Literally. So to protect themselves, in case the market suddenly crashes, they use financial hedges. They effectively short the futures market. The idea is that if prices fall, their physical product loses value, but their financial hedge makes money, which balances it out.
Okay, I see where this is going. On March 27, 2026, the Environmental Protection Agency finalized their renewable volume obligations, or RVOs, for 2026 and 2027.
Yep, the RVOs.
Which are basically the legally mandated quotas that dictate exactly how much biofuel must be blended into the national supply.
Precisely. That EPA ruling provided massive multi-year clarity for biofuel demand. Suddenly, the market environment for North American crushing and biodiesel became highly constructive. Prices and market dynamics surged rapidly in response to this, locked-in future demand.
So because prices surged instead of crashed, those financial hedges ADM had in place to protect against a downturn just immediately lost value.
Exactly. They had to record a $275 million loss on paper right then and there at the end of Q1.
Even though the physical oil they are holding, and will sell over coming months, is now worth significantly more thanks to the new biofuel mandates.
Right. The loss is recorded instantly, but the profit is realized later. It's just the timing. The policy guarantees a surge in demand for the very products they are breaking records to produce.
Wow.
Yeah, the underlying physical business is incredibly strong, but the accounting snapshot taken at the end of Q1 just looks completely bruised.
It's worth pointing out here for you, the listener, regardless of where anyone stands politically on green energy mandates, biofuels, or like agricultural subsidies, this EPA ruling is an objective reality for ADM's bottom line.
It's baked in.
Yeah. The EPA's stated goal with this finalized rule is supporting American energy security while prioritizing American farmers. Now, we aren't here to debate the politics of environmental policy or farm subsidies, obviously.
Obviously not.
But we have to look at how finalized federal policy literally writes the rules of the game for a publicly traded company of this scale.
And if you want to see what happens when that biofuel momentum translates into actual realized cash profits rather than paper hedge losses, we have to look at ADM's second major segment, which is carbohydrate solutions.
Oh man, this is where the numbers get really staggering. This segment's operating profits skyrocketed 48%, reaching $356 million.
That's a massive jump.
And the absolute standout star here is a division called Vantage Corn Processors, or VCP, which focuses heavily on corn dry milling ethanol operations. VCP's profit alone jumped by $94 million compared to Q1 2025.
They rode the ethanol wave perfectly. The sources note that VCP benefited from strengthening margins, highly effective risk management, and crucially, those exact policy incentives we just discussed.
Okay, wait a minute. I have to push back on this strategy, though.
Sure.
We just talked about how they took a massive paper hit in oilseeds because of a sudden shift in biofuels policy, right? And now they are showing a massive actual gain in carbohydrate solutions because of ethanol margins driven by policy. Isn't ethanol essentially a government-mandated, government-subsidized wave?
Yeah.
Like, how resilient is a business model that relies so heavily on the whims of regulatory incentives? If the political winds shift in Washington next year, doesn't this 48% profit jump just evaporate?
What's fascinating here is how ADM manages exactly that vulnerability on an operational level. You are entirely correct that relying solely on regulatory tailwinds is, a precarious strategy for a century-old company.
Yeah, it seems risky.
But ADM isn't just riding the wave blindly. They are executing a sophisticated internal balancing act using the physical architecture of their plants.
What do you mean by physical architecture?
Well, while the dry milling division captured the massive upside of the ethanol surge, ADM used that momentum to steady the other, less glamorous half of the carbohydrate solutions segment, which is starches and sweeteners.
Okay, and that would be the bulk ingredients that go into the processed food aisles at the grocery store.
Exactly. The global environment for starches and sweeteners right now is actually quite tough. They are facing continued pressure on global volumes and compressed margins in that specific space.
Right.
But despite that international pressure, the starches and sweeteners division still managed an 11% profit increase this quarter.
Okay, how do you squeeze out an 11% profit increase when the global market for your product is actively struggling?
By leveraging the flexibility of their corn wet milling operations. Let's break down the difference real quick. A dry mill essentially just grinds up corn to ferment it into ethanol and animal feed. It's a blunt instrument.
Got it.
But a wet mill is much more complex. It separates the corn kernel into different components: starch, syrup, corn oil, and ethanol. Because wet mills are flexible, when global sweetener prices are terrible, ADM can literally turn the dials on the factory floor to pump out more high-margin ethanol instead of low-margin syrup.
Wow. So they are actively using the physical flexibility of their plants to pivot toward whatever the government is currently subsidizing, which then protects their core food ingredient businesses while global consumer markets fluctuate.
Exactly. It is a highly diversified, physically risk-managed approach to a volatile commodity. It's a structural advantage built into their infrastructure.
They just turn the dials.
Literally, they have the sheer scale to absorb a shock in one area and capitalize on a boom in another.
Which naturally brings us to a part of the business that completely shifts gears away from these massive bulk commodity swings. Let's look at the third pillar of ADM, the nutrition segment.
This is a really interesting one.
Yeah, because while turning crops into fuel is highly profitable right now, ADM's original mandate was, feeding people and animals.
And the nutrition segment reveals a completely different corporate strategy. With carbohydrate solutions and oilseeds, ADM is playing a game of sheer volume, processing millions of tons and managing macro-level margins. Nutrition, on the other hand, is a precision game.
And it presents a really interesting riddle in the source data. In the nutrition segment, total revenue actually decreased by 1%, dropping down to $1.805 billion.
Right.
Yet, the operating profit for this exact same segment increased by a staggering 42%, hitting $135 million.
Yeah, it looks bizarre at first glance.
My immediate hypothesis when I read this was some kind of inventory liquidation. Like, how do you make 42% more money while selling fewer things?
Yeah.
Are they just dumping old stock?
It's not a liquidation at all, actually. It's a textbook example of addition by subtraction. ADM is fundamentally shifting its portfolio away from volume and toward margin.
Okay, explain that.
Let's look at the animal nutrition side first. Revenue there dropped by 5%, but their operating profit jumped by 55%.
That is a massive margin expansion for something as boring as animal feed.
They achieved it by forming a new animal feed joint venture with a company called Alltech. By doing this, they essentially took a large volume of their lower margin bulk animal feed business and restructured it out of their primary operational focus.
Oh, I see.
Yeah, this allowed them to concentrate heavily on higher margin specialty product lines. They aren't trying to sell the most feed anymore, they're trying to sell the most profitable feed.
So it's like a massive manufacturer deciding to stop producing millions of cheap bulk plastic widgets and instead retooling the factory to focus exclusively on precision medical devices.
That's a great way to visualize it.
The total volume of product going out the door drops significantly, but the profit left in the bank at the end of the quarter goes way up.
Yeah. And we see a similar dynamic in human nutrition. Profits there were up 39%. This was driven by a heavy push into higher value products like natural flavors and colors.
Right, getting away from the artificial stuff.
Exactly. The sources mentioned demand momentum building specifically for natural ingredients. Plus, they are finally seeing the continued recovery of production at their Decatur East plant, which just drastically improves their overall network efficiency.
So across the board in nutrition, they are actively shrinking their low-margin footprint to dramatically boost their profitability.
Yes, and this localized efficiency in the nutrition segment connects directly to ADM's broader corporate priority for 2026. Their leadership defines this as focus on growth with rigorous discipline.
Kitschy corporate slogan.
Always. But they back it up. They are currently in the middle of a multi-year cost savings program that kicked off in 2025. They are on track to save between $500 and $750 million over 3 to 5 years.
Wait, $500 million to $750 million in savings is huge. How are they cutting that much fat without cutting into the muscle of the core business?
By optimizing operations on a global scale, the sources highlight 2 major structural moves. First, establishing a new ADM Capability Center, or ACC, in India to centralize and streamline global operations.
Okay, standard corporate consolidation.
Right. And second, actively reducing transaction costs through digitization and artificial intelligence.
Okay, so I always get a little skeptical when, heritage industrial companies drop AI into an earnings report. Like, how does artificial intelligence actually help a company that crushes soybeans and makes corn syrup?
It's all about the back office friction. Think about the sheer volume of global transactions ADM executes daily. You've got shipping manifests, cross-border customs, supply chain logistics, supplier payments.
Just a mountain of paperwork.
Literally. Historically, that required armies of administrators. By digitizing those workflows and using AI to process and optimize those logistical networks, they reduce the cost of simply doing business across borders.
They are making their back office as aggressively efficient as their physical crushing plants.
Exactly.
Okay, so they are cutting costs, they are optimizing their portfolio to focus on high margins, and they're managing commodity risk to ensure survival today. But, cutting costs only gets you so far.
Right, you're to grow.
ADM's ultimate goal is long-term value creation. We know they generate strong cash flows. I mean, they returned $254 million to shareholders through dividends this quarter alone. But where is all the rest of this cash flow going tomorrow?
That is the big question.
And here's where it gets really interesting, because ADM is heavily investing in some genuinely futuristic technology.
They are looking decades beyond traditional agriculture. The sources lay out a long-term vision that shows ADM actively transitioning away from being strictly a farm-to-table aggregator.
They are pivoting.
Huge pivot. They are targeting 3 high-growth, high-tech areas: biosolutions, advanced nutrition, and functional health.
Let's focus on that first one, because the sources mention ADM's push into something called precision fermentation.
Yes.
They specifically highlight a successful trial creating scalable animal-free protein for pet food, as well as novel enzymes for human food applications.
This is a radical shift for an agricultural giant. Precision fermentation involves harnessing technological advances at the intersection of biology and engineering.
How does it work, basically?
Well, instead of growing crops in a massive field or raising livestock on a farm, you use engineered microorganisms like yeast or bacteria in massive fermentation tanks to produce specific, highly purified proteins, enzymes, or materials.
So they're basically hacking biology at scale.
Pretty much, yeah.
It sounds less like a traditional agriculture firm from the Midwest and more like a Silicon Valley biotech startup. Except, unlike a startup that might struggle to get out of the lab phase, ADM has a massive global industrial footprint to actually commercialize it.
Right, they don't have to worry about scaling up.
They can take a lab-grown, animal-free protein and instantly scale its production to feed millions of pets.
That infrastructure is their unique competitive advantage, and it extends deeply into the biosolutions category as well. They're unlocking entirely new markets for bio-derived materials to replace petroleum-based components in widely used household products.
Like what?
Think about the chemical cleaning sprays or laundry detergents in your house. ADM is working to supply the active bio-derived ingredients for those. They're also focusing on functional health, building a pipeline of solutions across mind-body wellness categories, specifically targeting the digestive and immunity markets.
So if we take a step back, what does this all mean for the company's financial future? Like, they have all these moving parts, the paper losses masking biofuel tailwinds, the massive ethanol margins subsidizing the sweetener business, the hyper-efficient addition by subtraction pivot in nutrition, and this heavy capital investment in biological innovation.
It's a lot to balance.
How does the leadership synthesize all of this into a forward-looking strategy?
They synthesize it with overwhelming confidence, actually. Because of these constructive environments, ADM updated their full-year 2026 outlook.
Okay, what are the new number?
Previously, they had guided for an adjusted earnings per share of $3.60 to $4.25. They have now raised that guidance significantly, targeting an adjusted EPS of $4.15 to $4.70.
Wow, that is a massive jump in their baseline expectations for the year.
It really is.
It shows they truly believe the tailwinds, especially from the U.S. Renewable Fuels Standard, will continue to drive outsized realized earnings in crushing and ethanol. And those earnings will easily cover the massive investments they are making in this biotech future.
Exactly. They explicitly state in the presentation that this updated outlook assumes the successful advancement of their company priorities and reflects expected year-over-year earnings improvement.
Driven primarily by that highly constructive margin environment.
Yep. They are balancing the volatility of today to fund the innovations of tomorrow.
And that brings us right back to you, the listener. If you take away anything from our deep dive today, it's that ADM's Q1 2026 is so much more than just a spreadsheet of corporate numbers.
It's totally an absolute masterclass in how a global giant operates.
Yeah, they're balancing volatile commodity valuations, they're extracting massive tangible profits from government biofuel mandates while taking the accounting paper hits in stride. They're literally shrinking their physical revenue footprint in nutrition to drastically boost their profit margins.
And they're using all of this accumulated cash to invest heavily in lab-grown biological solutions.
It is vital to understand these mechanisms because this isn't just abstract high finance.
No, it affects everyone.
Right. The food sitting in your pantry right now, the fuel you pump into your car, the cleaning products under your sink, and even the natural animal-free ingredients in your pet's food are currently being entirely reshaped by the margins, the federal policies, and the strategic corporate pivots we've discussed today.
ADM truly is the invisible engine behind a massive portion of daily life.
They really are. And that leaves us with one final, slightly mind-bending thought to ponder. We just spent time discussing ADM investing heavily in precision fermentation, creating scalable animal-free proteins, and manufacturing bio-derived ingredients for household cleaners.
Right.
They are literally hacking biology and fermentation tanks to replace the need for traditional crops and livestock. So, if an agricultural giant continues to aggressively replace traditional dirt and tractor crop-based ingredients with lab-engineered, precision-fermented biological solutions,
It's a huge shift.
at what point does ADM cease to be an agriculture company entirely and instead become the world's largest synthetic biology manufacturer?
That's the billion-dollar question.
And if that happens, what does the word farming even mean in the 21st century? Think about that next time you look at the ingredients on your grocery store shelf. Thanks for diving deep with us.